Welcome to How to Retire on Time, a show that answers your questions about all things retirement, including income, taxes, Social Security, healthcare, and more. This show is an extension of the book, How to Retire on Time, which you can grab today on Amazon or by going to www.howtoretireontime.com. My name is Mike Decker. I'm the author of the book, How to Retire on Time, but I'm also a licensed financial advisor, insurance agent, and tax professional, which means when it comes to financial topics, we can pretty much discuss it all. Now, that said, please remember this is just a show. Everything you hear should be considered informational, as in not financial advice. If you want personalized financial advice, then request your wealth analysis from my team today by going to www.yourwealthanalysis.com. With me in the studio today is my colleague, Mr. David Franson. David, thanks for being here.
Yes, happy to be here. Thank you.
So David's going to be reading your questions, and I'm going to do my best to answer them. You can send your questions in by either texting us to 913-363-1234. That's 913-363-1234. Or email them to heymike@howtoretireontime.com. Let's begin.
Hey, Mike, what's the difference between a DST and a REIT, an REIT?
Yeah, REIT is a real estate investment trust. So think of it as it's a trust, but think of it as kind of like an LLC or a business. You're buying shares or part ownership of a business here. DST, similar concept, except for instead of owning part of a trust or part of a business, so to speak, you own fractional interest of the actual real estate. And the reason why this is so important is if you're a landlord and you want to sell and you don't want to pay taxes, which many landlords don't want to pay 30% or whatever it is on
it's
their,
painful
on their
parting
tax.
with all that money, right?
I mean, yeah, you got $1 million property, or $10 million apartment complex, or maybe you got 3 or 4 houses and you sell it all. Chances are you've depreciated the asset to zero, which means 100% of what you sell is subject to gains or capital gains tax.
Okay.
So you end up in these horrible situations where you're paying, a lot of money in taxes, 25, 30% or so, depending on where you live. That sucks.
Yeah.
Pardon my French, my teen French.
Yeah, right.
But it's not a fun situation. And so a lot of people will hold on to the real estate properties because they don't want to pay the taxes. And I get that. And so people will say, well, hey, we can do a 1031 exchange. That's where you sell your property. You move the proceeds to a qualified intermediary. So you didn't touch any of the money. And then from the QI, they can send it to a DST. A DST qualifies for a 1031 because you're buying, let's say it's, for simple math, an acre of the property. Maybe you bought 10% of the property. You with me so far?
Mm-hmm. Yeah.
A REIT, you're buying a part of a business that doesn't qualify for a 1031 exchange. So if you were to sell your $1 million real estate portfolio for simple math, you would pay the taxes, and then what's left over, you could still be in real estate. It's just you had to pay the taxes. You couldn't move the money out of your current position, your current real estate portfolio, and put it into a REIT. Doesn't qualify.
Okay.
And the reason why this is important is because there's no such thing as a perfect investment product or strategy. When we consider real estate parts of our portfolio, if you have real estate, actual real estate, you're a landlord, it may make more sense to sell your properties because you're just sick and tired of tenants, trash, and toilets, and you move the proceeds to a QI, and then you buy a couple of DSTs. So you maintain your cash flow, the asset appreciates in value, and when the DST becomes liquid, in 5, 7, 10 years, whenever that time frame is, you then continue to roll it up. So then your kids get it all tax-free because when you pass, real estate gets a step up in basis. Basically, you don't pay taxes on the gains when you die.
Okay.
Yeah, that's why there's a common expression, Grandma, don't sell me your house. Give it to me when you die because you get it then tax-free in some sense. There's property tax, there's some tax, but the gains, okay?
Yeah.
Whereas a privately held REIT is more of saying, I just want a part of my portfolio to be in real estate, but I want it to be diversified. So you can look at REITs that specialize in, you name it. The privately held REITs, in my opinion, are better than publicly traded REITs because publicly traded REITs have to keep more cash on hand in case you were to redeem your shares that you'd want to cash out. Privately held REITs have more money going to the assets. So you, in my opinion, again, have in what I've seen, you've got a more competitive return. So it appreciates in value. You can also get a dividend from it or payment. So you just have to understand where's your money now and where are you trying to send it. Am I explaining that okay?
Yeah, I think I get that. Yeah.
So it's complicated. JP Morgan, a company most people have heard of, did a very interesting research project. What they found was instead of your typical portfolio of stocks and bonds, if you include around 30% of it in alternatives or real estate, you had better growth historically and lower volatility. Why is that? The stock market or equities is independent of the bond market, which is also independent of the real estate market. So if you diversify them, they can help each other. When one is struggling, the other two hopefully would pick up the slack. So it's kind of a nice thing that makes sense. So if you're not currently in real estate, maybe you want some REITs in your portfolio, privately held REITs, which you can't get on your own. You have to go through a licensed financial professional for the good ones. You got to make sure that the proper due diligence is done before you buy them, and make sure you're working with a fiduciary that can't get a back-end commission, because many of these REITs pay a very fine commission to someone who has a Series 7 broker-dealer license. I don't have that.
So explain a back-end commission? Just how does that work?
Yeah, so like, for example, DSTs, it's a product that's commission-based, okay? So if I had a Series 7 license, and I'm being really transparent right now, if I had a Series 7 license and I sold someone a DST, I'd get 5.6 commission or so as a kickback. Because it's an illiquid asset, they pay the person that brought the money in there, all is well. Because I can't get that commission, the client gets the commission.
Okay.
So instead of paying me that, it's just rolled up into the client's asset. Because I have a Series 65 license, I cannot accept back-end commissions. I can only charge for my time or fee for advice.
Okay.
And that was on purpose, by the way. I've had so many people say, why'd you do that? You're leaving money on the table. Because it's the right thing. And I got to be able to look at the mirror and look at myself. So with REITs, sometimes, and I don't want to be accusatory,
right.
We need brokers and dealers to move money around. They have their place. But if you go through a fiduciary as in a Series 65 license who cannot receive a back-end commission, maybe the due diligence is done a little bit differently. Maybe they're recommending a couple of different products because you're paying them for the hour or for the advice. That back-end incentive isn't really there. Now, I'm probably oversimplifying this. There's a lot of complexity from compliance, but that's the idea, is that you're working with someone that can give some honest feedback about what would be the real estate component within your portfolio. How does it break down from a complexity standpoint? What's the liquidity of it? What's the history of it? What are the, you got to almost be like a CPA vetting these things because everyone wants to sell you something. So you have to see through the marketing crap and get to the real details, the nitty gritty.
Yeah.
Again, it's just, there's no such thing as a perfect investment product or strategy. Real estate can be a very competitive thing in your portfolio. You just got to make sure you're going about it with your eyes wide open. That's all the time we've got for the show today. If you enjoyed the show, consider subscribing to it wherever you get your podcasts. Just search for How to Retire on Time. Discover if your portfolio is built to weather flat market cycles or if you're missing tax minimization opportunities that you may not even know exist. Explore strategies that may be able to help you lower your overall risk while potentially increasing your overall growth and lifestyle flexibility. This is not your ordinary financial analysis. Learn more about Your Wealth Analysis and what it could do for you regardless of your age, asset, or target retirement date. Go to www.yourwealthanalysis.com today to learn more and get started.